Hello, hi, welcome everyone. Let me just quickly get set up on this. Oops. Okay. A very good morning. Happy Saturday. And thank you for spending your weekend together with FSM1 on this topic of how to research and choose an ETF, right? So today's session will be around 2 hours. We will be actually having a short break in between. So the first 1 hour, we'll be going through a topic, and then we'll have a short break, and then we'll continue with the second part of it. And along the time that you have any questions, you can actually use the chat box or also post it in the Q&A session. And during the before the break and after the break, and also after at the end of the session, I'll be actually taking in all the questions. All right. So to start with, the session today, it's for learning purposes. And what I need you to get prepared is that if you have your favorite cup of beverage, get ready. Can be either tea or coffee. I have my coffee here, right? Get a notebook to write down the notes, to take down notes. And you don't have to actually take screenshots on all that. And you can just focus on the today's session, because next week we will be actually sending a replay. Once we have done editing, we'll be sending the replay of the session, so you can actually go through again if you have missed some of the things that we are going to learn today. Okay, so before we get into the session, disclaimer is that the entire session today, it's for education purposes only. It is not an investment advice. And as always, do your own due diligence before making any investment decisions. Okay, so let's get started. The main agenda of today's topic or masterclass is that on learning about ETFs. Like from the previous session, I believe that some might have actually attended my previous sessions on ETF, this topic in particular. But today we're going to go a little bit deeper and to explore on ETFs. So this is a bit of a beginner and intermediary. Okay, and we might touch a little bit of advanced, but that is kind of the outcome that you can actually expect to get. The first part is we're going on the basics of ETFs. What are the factors that we need to consider in analyzing an ETF? And once you have gotten this, then you have this knowledge and you will know how to actually research what are the things to look for in an ETF when you're doing a research. And then we'll have a break. And after that, we'll go into the investment strategies of constructing an ETF portfolio, and what are the tools available on FSM1 that you can actually use to actually achieve your investment goals. All right, so let's get started. ETF 101. Okay, so what are ETFs actually? So ETF, it's actually an investment tool, right? So in the universe of investment instruments, right, you have our unit trust, we have our stocks, bonds, and recently cryptos. So in that same universe, ETF is one of an investment tool. Okay, so it is actually an acronym that stands for exchange traded funds. So what it literally means is that it is actually behaves like a stock which is traded on exchange. For example, the New York Stock Exchange, Nasdaq, Hong Kong, the Bursa, and where you can actually buy and sell like a stock, since it's traded like a stock, right? But what makes it a bit different from stock is that the way it behaves. So how ETF are structured is that it actually behaves like a fund. So fund, to put in context, it's like unit trust, because some people might not understand the concept, the word funds, but for us Malaysians, like unit trust it's a more better way to understand it. So in this sense, a fund it consists of a basket of products. So it could be equities, means stocks. It could be also other underlying instruments like bonds and whatnot. Okay, so that is just a brief on ETFs, and we will go deeper on that. So how an ETF is structured is that, okay, so ETF, like I said before, it's that it behaves like a stock because it's tradable. It is listed on a stock exchange. But at the same time, the way that it's structured is that it's also like a managed fund, or in other words, a unit trust. So it kind of like gives the qualities of the unit trust. At the same time, it has the function of a stock, okay, whereby it can be something, ETF it's something that you can actually buy and sell on an exchange, but it is not a stock, because when we talk about stock, right, for example, Maybank or Apple, then in our mind comes in that, okay, if I buy Maybank, that means I'm like part ownership of Maybank. But then if I buy an ETF, what does it mean then? So that what it means is that you're actually owning an instrument which has underlying assets to it. So it's not only just one company, it could be a diversified companies under it. Okay. So the next important thing to know about ETF is that ETFs, it might be something that is that you might be hearing now, because it's getting a lot of traction, a lot of attention the past couple of years in Malaysia. But this is something, it's not something that is new, right? So ETF has been in the industry, in the investment world, for more than for almost 30 years, 20 years plus. Yeah. And these are some of the largest ETF issuers in the world, or fund providers. So if you want to get an idea, it's like, for example, in unit trust, right? You have your principals, AHAM, and these are the RHB. These are the providers of the unit trust fund. So similarly, these companies are actually the providers of ETFs, means they are the one who actually issue a particular ETF. So here you can see that the most common names are like Vanguard, iShare, Fidelity, State Street, iShares, and BlackRock, JP Morgan. And the global market for ETF, it's around 38 trillion as of last year. And there are actually more than 3,000 ETFs in US alone, and globally it's around 5,000 plus. And they're just new ETFs that's coming. And you might also heard, like in the news, they are actually looking to list ETFs for cryptos, for Bitcoins, for Ethereums. So ETFs have been actually gaining more tractions, especially in Malaysia, because now Malaysians can actually have access to it. It's easier for Malaysians to access ETFs because most of the ETFs are actually listed in the US market. So in other sense that there are more opportunities for Malaysians to access, since there are more opportunities for Malaysians to access US markets. So indirectly, we could actually have access to ETFs, right? So how does it work then? So before we go into how ETF actually works, is that one thing you have to understand is that we need the core principle of how an ETF works is that it's actually tracks an index, right? So what does it mean by tracking an index? Okay, so you will know, usually if you read about ETF, they say like this particular ETF is tracking an index. So what does it mean by tracking an index, right? So in index, it's actually designed by committees. For example, this particular index, the S&P 500 index, is designed by S&P. So that could be MSCI. So that those are institutions that actually design indexes. So, and then each index has a function, means it does something, right? And oftentimes it's actually very straightforward from the name itself. You will know that what is the function of that particular index. So let's take, for example, this particular index, the S&P 500 index. So what it means is that the S&P 500 index is an index that tracks the 500 largest by market cap companies listed in the US stock market, right? So it's pretty straightforward, right? It's just top 500 by largest market cap listed in the US stock market. So let's say, right, I'm interested in this index, particular index, and usually index are used as a benchmark to gauge the performance of a market. So if you read news about on business news, you'll see that you'll hear these terms like the S&P 500 went up by this percentage points or went down by this percentage points, or previous to the S&P 500 was the Dow Jones index, right? Or in Malaysia, you'll see that like the KLCI composite index, right? So these are the terms that you actually will hear when you read on business news. So what if actually, but the thing is that you cannot actually own an index, right? It is just a measurement, a way to measure, right? For example, here, you see that there are actually no dollar signs here. So they are just numbers that represents this index. But what if I just want to own this particular index? So this is where an ETF comes in. So an ETF, it's actually an instrument where it aims to track or replicate an index, and where we can actually buy and sell that particular instrument. So this ETF, which is the Vanguard 500 Index Fund ETF, aims to actually replicate or track the S&P 500 index. And here you can see the dollar sign. So this is, if I'm actually interested to actually buy the index, I cannot actually straight away buy an index. I need to have an instrument that actually replicates or tracks the index by using an ETF. Okay, so far so good. So along the way, I'll just like build on the information that I've been sharing, so that it actually builds on top of one another, so you get a better understanding when we go further down today's session. So number one is that ETFs are exchange traded funds. They are traded on a stock exchange where we can buy and sell them like a stock. But how they are different from a stock is that instead of just one company, they actually have a basket of assets under them. And how ETF mainly functions is that it usually, or most of the time, it actually tracks an index. Okay, so an example here is that the S&P 500 index, and the ETF that tracks that particular index is the Vanguard 500 Index Fund, or the ticker symbol for it is VOO. Okay, so some examples of ETFs, their ticker symbols, and the index that they track. Okay, these are the common examples. You might actually heard of these ETFs, for example, QQQ, which tracks the Nasdaq 100 index, means the top 100 companies that's listed on the Nasdaq stock exchange. And there are also some very different types of ETFs. For example, this particular ETF, the JQUA, the JP Morgan US Quality, it actually has a particular index that it tracks. And then we have Sharia related index. So this is like, depends on what, very specific to Sharia related companies. So that is the ETF, and this is the index that it tracks, the S&P 500 Sharia Industry Index. So in Malaysia, then we have our own ETFs also. So if you're interested to buy just the Bursa KLCI index, right? So there are 30 companies there. Either you buy all the 30 companies one by one, or if you just want to get an exposure to all the 30 companies, then you can just buy the index itself. And same goes with the Hang Seng index. Okay, so I hope that you get an idea of like how an ETF, what's the relationship between an ETF and index. Okay, so far so good. Then we'll go to the next part. So this is where we go a little bit deeper and explore a little bit more on the different types of ETFs. Okay, so we have established that ETFs generally they track an index, and then they actually consist of a basket of products under them. So they are not necessarily stocks or companies. They could be actually various different things. So this is where ETF actually gets a bit exciting, because there are so many things that you can actually play around with it, right? So the most common basic ones are the stock indexes, means they just track the broad market, like the one that we covered previously, right? The S&P 500 and the Nasdaq 100. So these are the example of ETFs, the VOO, the QQQ. There are also certain ETFs that actually tracks, they are industry specific. So in sectors, it could be either industry specific or sector specific. So for example, the tech sector, consumer staples, discretionary, financials, and the related ETFs are this XLK, XLY. Then it's like I said, it's not only limited to stocks. It could also be for fixed income bond, where they hold treasury bonds, or can be also corporate bonds and different types of treasury bonds. Commodities, your gold, silver, oil, currencies, basket of currencies, or even it could go a little bit interesting whereby either it could be bullish or bearish, right? REITs, the real estate investment trust. And then these are the different types of actually underlying instruments. And then when we go to also the way that you can actually structure the ETF. So this is where the leveraged and inverse ETFs comes in. So what it means by leveraged is that, as the word suggests, right? Leverage is that you use something to have greater impact, right? That's the aim of a leverage. Okay. So for example, this particular ETF, right? The TQQQ, Ultra Pro QQQ. So you have your QQQ. Okay. So what does QQQ does is that it tracks the Nasdaq 100. But the ProShares Ultra Pro is that it gives you a leverage impact. Means that when you get a 1x return for QQQ, with a leverage ETF, you can actually get 3x returns. So it actually amplifies the return, right? But this we have to be also we have to keep in mind that the reverse could be also true. When the market is down by 1x, then the leverage could also go down by 1x, right? And at the same time, there are the inverse ETFs, whereby it behaves the opposite of the direction of the market. For example, if the market is going up by 1%, the inverse ETF aims to go down by 1%. So it actually depends on your strategy. These are the available tools, and how do you see the market? And you can actually use these particular tools to actually use it. So here leverage, right, could also go two ways. For example, here the TQQ and SQQ. So SQQQ, it's actually an inverse ETF, right? But at the same time, it's also leveraged, right? So here it can actually do both. You can have a leveraged, you can have an inverse that is also leveraged, okay? And then finally, we come to the smart beta and actively managed ETF. So a smart beta ETF, it's rule-based. A smart beta ETF also tracks an index, but that index is not like a broad market index. For example, this is S&P 500, right? But they actually have a rule designed to track. And then we have the actively managed ETF, means they don't actually track an index. So this is kind of like your unit trust, where you have an active fund manager that's managing it, but it's actually structured as an index. Okay, so just an overview, and we will just along the way we will go explore a little bit deeper on each of it, right? But before we do that, let's just wrap up on this first part on why should we use ETFs? What are the pros and cons, right? So as I said, ETF, it's actually an investment tool. I'm sorry, I just got a chat. Okay. And the pros, it's here. It's that the cost of it, the low expense ratio. I will get into it in a while. Why is it so? Why does it have a low cost? Diversification. So instant diversification. So like, for example, the earlier we saw, right, the S&P 500. VOO, the ETF that tracks the S&P 500. So just by owning this one ETF, just one ETF, you instantly get access to 500 companies. So imagine that, let's say you want to buy the entire US market, right? So instead of like you buying all that 500 companies, how much will that cost you? So instead you just buy this ETF that tracks the S&P 500, you get instant access to these 500 companies. And next is that automation. Because if you're actually buying individual stocks, then you will need more monitoring of your stock compared to buying an ETFs, because it has a large, one thing it's that it has a large number of stocks that it's in there, and those ETFs are automatically adjusted and rebalanced by the issuers. So that's nothing to do on your side. I mean, because the ETF actually aims to replicate the index, right? So those who are in charge of the ETF, this is their job to do this, and that's why you have an expense for that. But it is not your job. So once you have done it, bought it, and you just let it run. flexibility because it's traded like a stock. You can actually buy and sell anytime. So how this is different from a unit trust is that, as we know, unit trust actually it takes time for it to be reflected and when you redeem it. But this is kind of instant because it's like a stock. And transparency, it's that you can actually see all the holdings that is under an ETF. At the same time, every investment tools, there are pros and cons. So it's how we actually manage our risk. All right. So ETF actually does not perform well in all markets, right? So why do I say this is that, for example, right? Let's take the KLCI and as an example, right? So the KLCI index actually tracks the 30 top companies that's listed on Bursa, right? But if you look at those 30 companies, right, most of them are actually in the financial industry, financial sector, and GLCs. But then if you look at our economy, Malaysia as an economy, right, the largest contributing sector for the Malaysia's economy, it's the electric and electronics industry. So there is actually a mismatch between the economy, the nation's economy, and also the market itself. You can actually, another example is also the China market, right? So we can say that, mostly these developing countries, emerging markets, it's actually a little bit harder to actually use ETFs to actually invest. ETF actually performs better in developed countries because of one thing is that the efficiency of the market means that the market is efficient. Information about about stocks are readily available. Everybody gets the same information. So it's very hard to actually beat the market because you don't have anything extra that the public or everyone that doesn't know already. Whereas in Malaysia, like for example, if unit trust, then the fund managers could actually have closer connections with the companies that they're investing. They actually go on the ground to do research, and these are the informations that is not easily available for retail investors. So that gives them an edge to actually construct their unit trust portfolio. So that is something to actually keep in mind. Next is that closure of ETFs. If ETF, there are actually, as I said, more new ETFs are coming in. So if the ETF it's not big enough and there's no volume and they might need to close down, then if you're invested in that, and then this is something like a stock that gets delisted. So in similar sense. And next is getting market returns. So you always hear this term, right? When actually unit trust or just fund managers say that they always have a benchmark. If you take up a fund fact sheet of any unit trust, you'll see that the performance of the fund versus the benchmark, right? So now the aim here is that you are not beating the benchmark, you're just following the benchmark. Because at the end of the day, all the benchmarks, right, you can actually go, like today, go and look at any fact sheets, the benchmark, most of the benchmarks, and then you can actually find out that what are the ETFs that tracks this benchmark. So ETF, benchmark is an index. So ETF actually consists of, ETF actually tracks indexes and which is used as a benchmark. So in other words, the returns that you get are actually market returns. It's not something that is more than outperform the markets. Is it good or bad? Well, depends. And another con is that diversification. Okay, this is something interesting, and I'll guarantee you this will happen. Okay, after today's session, once you gotten all this information and you have started your ETF investments, right, then you will know that actually it's not that hard to actually buy ETFs. And what you don't want to do is that to assemble or to become an ETF collector means that you buy too many ETFs, right? Because it like get excited and then it's like, okay, this is fun. And then you go and buy too many ETFs, right? That's actually two parts to it. Because one is like fear. I don't want to buy. But once you get into the game, then you get hooked. So you need to be really careful on this. Why? Because when you actually purchase one ETF, right? So that is like, for example, the S&P 500, that is like equivalent of purchasing 500 companies. So if you actually buy too many ETFs, you'll have thousands of companies indirectly. You're owning thousands of companies under your portfolio. And what happens is that this kind of dilutes your returns. yeah, if they're actually in different sectors and diversified, that's good. Then when the market is down, then you don't get the impact. But the reverse is also true. When the market goes up, then also, you also don't get the full returns of the market. Okay. And lastly, is limited control, because this is, I'm not sure whether it's pro or con. Let's just put it under con, but I'll say it's also pro, because the less we meddle, the better it is. Limited control in the sense that you don't have any say that what goes into the index. So you don't have like exact control of what are the companies, exact companies that you need to get. Okay. So now it's, oops. Okay. So let's take a breather. So, and I hope that you have your paper and pens ready, because we are going to go more deep into analyzing different types of ETFs, right? Okay. So earlier, we have actually established that ETFs are actually could be actually passively or actively managed, right? So most of the ETFs are actually passively managed. Some are actually actively managed. So what it means by passively managed is that particular ETF, the job of that ETF is just to replicate the performance of an index, because the index is already there, the index is already structured. So the ETF actually just copies, it just replicates that particular index. That's all. I mean, they don't do analyzing market research and all the stuff. The purpose of the fund manager is just to copy that, right? And therefore, it has a lower expense ratio. Whereas an actively managed ETF it's whereby you have a fund manager that is actively deciding what goes into that particular ETF. What are the holdings, the companies that goes into that particular ETF, right? So a very famous one for the past couple of years was this the ARK investment by Cathie Wood. That's an actively managed ETF. Since there is active involvement by a fund manager, therefore there'll be high expense ratio, right? So here you can see example. So we have, so I'm slowly actually introducing you the different types of ETFs here. So the VOO, that's the ETF that tracks the S&P 500. So you can see that since this is passively managed, so the expense ratio, it's 0.03. Whereas the ARK Innovation ETF, which is actively managed, the expense ratio is 0.75. You see, that's actually a stark difference there. And another thing is that, that's point number one. Point number two is that it's passively managed because it tracks an index. Whereas an actively managed ETF, it does not have an underlying index. And that's why it's actively managed, because the fund manager is actively buying and selling, trading to include or not to include certain stocks under their ETF, right? So there's no underlying for them to replicate or to copy or track. Okay, so that's on this part. So the next is that how an ETF could be structured. Either they are market cap weighted or equal weighted ETFs. What it means by market cap weighted is that a market cap is actually the share price. What is the price of the particular stock today times by the number of outstanding shares that forms the market cap of a particular company, right? So a market cap weighted ETF actually it's structured in a way that where larger companies with bigger market cap have more presence, impact on the performance of the ETF, okay? Compared to an equally weighted ETF whereby doesn't matter what is the market cap of that particular stock, right? Everybody gets an equal weightage or equal representation in the ETF, okay? And usually the expense ratio is higher because the index, it's actually market cap weighted, right? Index, like for example, if you take the S&P 500, and the S&P 500 has been going up since October last year. But if you actually look closer into that, the market going up, you'll see that it's mostly due to the Magnificent Seven, just these top 7 companies due to the AI hype, right? You have your mostly these tech companies. So the performance of that index is skewed towards these companies, right? So that because since they have a larger market cap, their movement have a more significant impact. Whereas in an equal weighted, since everybody have equal percentage weighting inside an ETF, and since this needs to be done, there need to be active management to make it equal weighted. Therefore, the expense ratio will be also higher, right? Let me show you what I mean. So this is VOO, the Vanguard S&P 500 ETF, okay? So the index that is tracked is S&P 500 index, and you can see the weighting here. So the larger companies, their weighting in the index, in the ETF, it's actually higher compared to the rest of the companies, right? You can see the percentage here. And since it is just following what the index is doing, so therefore the expense ratio is 0.03. It's lower compared to this particular ETF, the RSP. See, the name itself says that S&P 500 equal weighted ETF. So you can see that everybody, all the stocks under the ETF has equal weightage. It's like 0.23, 0.24 in that sense. And since the fund managers needs to actually maintain this weightage actively, therefore the expense ratio is a bit higher. So which is better, this or that? That is actually another topic. But what's important here is to understand that there are these two types of representation. Okay. And next one, replication method. So under the replication methods that, so remember we have already established that an ETF actually replicates an index. So how do you actually do this? We know what they do. How do we do it? It could be either by physical replication, where the particular ETF actually physically holds all the securities under the index, or it's through synthetics. So they could actually use derivatives and swaps. So that means they are not actually holding that particular asset that they say that they're replicating. So they actually pros and cons there. And also the way that physical ETFs replication method could be either full replication. What it means by full replication is that, let's say S&P 500, there are 500 companies there and they buy all the 500. Or they could actually use sampling method. Sampling method means that they don't actually buy all the 500 companies, but come out with a method that most closely represent the index that they are tracking. So these are the ways they could do it. Okay. So we are done on that. And next is that the index methodology. Okay, remember earlier we saw some ETFs, right? And whereby they have different types of indexes they have. So the indexes and how they track the indexes, it's also a bit different. Okay, what I mean by that is that here, for example, the VOO, these ETFs, they actually track the S&P 500 index. But what does it mean by the S&P 500 index? So they are the top 500 listed companies by market cap. So this is a point that you also need to take note, is that when you actually read, it says that this ETF tracks these particular ETFs, then you must know what is that index is actually, sorry, when this particular ETF tracks this particular index, then you must understand what does that index mean, okay? So the broad market indexes are very straightforward. It means what it says, S&P 500, and what it means is that the top 500 listed companies in the US by market cap. But then after that, some of that not most common one, then you need to do more research on it, right? So like Russell 2000, if a common, if you just look at the common understanding will be like 2000 means just like 1000 to actually 2000, but it's actually the 1001 and 3000 listed market cap by company. But this sounds a lot. Like if you just look at the number, like okay, it's like looks a lot, but then when you look deeper into it, it just represents 7% of the total equity market, right? So by having Russell 1000 itself, it's like almost the entire market, right? And then the total market index, which is the entire market with at least 15 million market cap. Okay, so this is by market cap. There are also certain index like the traditional Dow Jones Industrial Average, which does not use market cap, but they use price weighted index, right? So it doesn't, it is like which stock has the highest price. So they're just different methodologies, which is right, which is wrong. That is another question, but just what we have to understand is that what is the methodology that they are using, okay? So other type of methodology that can be used here are rule-based methodology, for example, right? So these are called the smart beta, your so-called smart beta ETFs. Smart beta, it's like in between an active and passive kind of management, where active is whereby there's no index, there's no underlying index. Whereas smart beta, they have underlying index, but those underlying index are not like very straightforward like the broad market indexes. They have certain rules to it, like how the index is being formed. Okay, for example, the PNQI, which is the Invesco Nasdaq Internet ETF, it tracks the Nasdaq CTA Internet Index. What this index does is that it has certain rules. It's US listed internet companies, and it has some rules of how they select that ETF. Rank 8%. Okay, same like the JQUA. It select companies for the Russell 1000, but they use these 3 factors to actually select those companies. And then the Morningstar White Mode Focus ETF, which tracks the Morningstar White Mode Focus Index. They select 40 companies, which they think that has the highest fair value. They have their methodology to how to do it. And also by using the factor of competitive advantage. So this is like following Warren Buffett's having a white mode, strong mode companies to have competitive advantage. So they actually use that investment philosophy to actually come up with an index. Okay, so where do you get this information, right? So most of the time that you need to actually Google and find out from the company's website. So here, like for example, here the mode, the one we saw earlier, right? MOAT. Okay, MOAT. So this is what they say, like you can actually find out on their website. They give you like what are the rules, construction rules for the Morningstar White Mode Focus Index. And then they give you this like step-by-step like guide. How do they actually do it? How do they actually select it and do it? So it is kind of like active in the sense that they select it, but the criteria, the rule that is set, it's not very detailed, very deep, deep analysis. It is just if all these companies pass these specific rules, then you're on the index. Okay, so the PNQI also that tracks the internet companies. So you can check on the index page also, and they have listed the criteria they use to actually the 40 companies, right? So how do they pick these 40 companies? And these are the criteria that they have picked. So if the particular stock fulfills all these criteria, then they would be in that index. And after that, how do they actually weight it? Like who has more weightage, whether it's equal weighted or market cap weighted, how do they do it? And then they will also show you the calculation of how they do it. Okay, so is it important that you need to know this, like detail like this? Yes and no. If what's more important, it's like just have a general understanding of what it does. You don't have to go too detailed to analyze, but if you're interested, you could do that. But just have an idea when you're getting into an ETF, what exactly that ETF does, right? Rather than just simply buying that ETF, have an understanding of what that ETF does. Okay, so the next topic is on the costs, right? There's several costs, namely the expense ratio, the brokerage fees, tax, and forex trades. Okay, expense ratio, it's the cost of owning that ETF. It's similar to the management fee that you have in unit trust, because those ETFs are actually being managed by fund managers, either passively or actively. So there's an expense there. Brokerage fees, this is like depends on which, because since it is a stock, right? So it depends on which broker that you're using. So that varies. Tax. So when it comes to tax, this is a very common question, right? So on the tax part, it's that there is a 30% dividend withholding tax. So what it means is that when an ETF declares dividend, so it's similar to a stock, right? They can also declare dividend. The dividend that we get as investors is after minusing the 30%. So the dividend that I get it's already minus 30%, and that's the money that I can get in as dividend, right? Whether to declare this dividend as an income for Malaysia tax, that you need to consult with your tax advisor, right? But what you need to understand is that it is not that you get this and then there's additional tax. It's like already tax and then you get it. So that's usual confusion that I get from clients. The next is estate tax. Estate tax is that and the investor passes away and he has assets, and then to transfer the asset, then there will be estate tax. But for this also need to consult on the tax advisor on the details of this. But just note that you know that these are the potential costs that could be involved. And lastly, FX rate. Okay, this is the fun part because ETFs are actually listed across the world, right? So if there's an exchange there, most exchange they carry ETFs. So like on platforms like FSM1, you have the ability to actually to have access to ETFs that's listed on the Singapore stock market, Hong Kong stock market, US stock markets. And since these are on the listed on the foreign stock markets, then there is the impact of foreign exchange. That's number one. Number two, it's that how foreign FX rate FX is this way. Oops, sorry. Okay, I'll actually, my apologies. I will actually explain that in detail after this. Let me just get into the expense ratio first. So, right, expense ratio. So expense ratio, ceteris paribus, right? When all things equal, when everything is the same, you have this option of whether to invest in this ETF or this ETF. So when you look at what the ETF does, VOO tracks the S&P 500 index, SPY, this particular ETF, tracks the S&P 500 index, but what makes them different is the expense ratio. One is 0.03, one is 0.095. Right? I mean, does it make a difference? The difference in the exchange ratio? Well, in the shorter term, it's not that much. And if you have a small account, not that much. But on a longer term, when your account size grows, then it gives an impact, right? For example, here, so one is 0.03, one is 0.095. You started with a 10,000 investment and you top up every year, 5,000. Let's say with an investment return of 10 years, 10% per annum for 15 years, that's a difference of 1181. No, I mean, this is the difference more if you have invested in the one with the higher expense ratio. So what if your capital is bigger? Then the difference becomes more prominent, right? So if your capital is small, like if you're just starting with 10,000 and you don't add in anything, in 1 year, that's like $7 different. But when you look at it in a longer term and in a larger capital size, then the difference becomes more material. Okay. So yeah, now let's go back to the Forex. I'm sorry, the arrangement of the slides. So we spoke about Forex earlier, right? So one is that the currency of the country that you're investing in, from ringgit changing to Sing dollars, to Hong Kong dollars, to USD, that particular exchange rate. Another one is that when you, for example, here, right, this is an ETF that's listed in the US stock market, but it invests in Japan. So it's the FTSE Japan RSI capped index. It tracks the market cap and weighted index of Japanese equities. So they are in Japan. So they need to get it in yen. So now there's the exchange, the currency impact of ringgit to USD, and then also when you buy this ETF that buys stocks in yen, then that's the USD to yen impact. So that's two currency impact over here, right? And actually it makes a difference. For example, right, you can see the difference here. FLJP FLJP, and FLJH. Okay, they are basically the same thing, but what is different is that the one with the H is hedged, is currency hedged, right? And you can see that there are a significant difference in the returns. So year to date, without the hedging, 7.76, with the hedge is 27%. And for 5 years, that's a huge difference. And that's in USD. But then remember, that's also the USD to the ringgit to USD. So if I toggle this to ringgit, then this figure will be larger since ringgit weakened and dollar strengthened. And this is because the dollar strengthened against the yen. All right. So these are the things that actually you need to also consider. Also, like for example, if when you're going for geography based ETFs. Okay. So there's one option. Another example is that, let's say you want to buy an ETF that tracks the Hong Kong market, Hang Seng Index, right? You could either buy an index that is listed in the US, then you have the double currency exchange, or you can actually straight away buy an ETF that tracks the Hang Seng Index listed in the Hong Kong market itself. So you just have that one currency to worry about. Which is good, which is bad, I'm not saying that. I'm just saying that you need to be aware of this. This is how it behaves, right? Okay. So what are the other factors? So we're almost at the end of the session. It's going to be our break time now, another 10 minutes. So some other factors to consider, it's that the tracking difference, how well does the ETF is tracking the said index. The smaller the tracking difference, the better. Liquidity, it's that the size, the volume of the ETF that's being traded, right? Either both on the stocks that it's holding and also the ETF itself. And why this is important? Because it will affect the bid and ask spread, the spread of buying and selling, the bid price and the ask price. Why? Because when it's thinly traded, lower the volume, then the spread will be higher. That will be actually additional costs for investors. And underlying concentration of the underlying holdings. It's like just now the examples that I gave earlier, right? It says that S&P 500 is the top 500 companies, but that is not always the case. There are many ETFs which could have like very small holdings. So then this could be also a risk to you. So these are things that you have to consider. So one example is this one. Okay, we have our usual suspect, our VOO, the exchange ratio. See, the spread is low, big volume, the daily volume is high. But else, this is a funny one, right? It's called the Tuttle Inverse Kramer Track ETF. So I'm not sure if you guys know or not. There's this TV personality in the US his name is Jim Cramer. So the story is that whenever he recommends a stock on TV, right, he asks people to buy this particular stock, right? And then that stock actually will go down in value, right? So these guys actually came out with this ETF that said that's called the inverse Kramer, means that if Kramer today goes on TV and says that buy Tesla, they will actually do the opposite and short Tesla. Okay, so and as you can see that it's kind of like a meme, I don't know, but since it's actively managed, so the expense ratio is like huge. But since the volume is like so low, I mean, I wouldn't say so low, it's low, the spread is high, and it has a very high concentration risk of just 7. So this is more like, I don't know, if you want to just have fun with it, but not something that you might want to do for investment on the long term. Okay, so these are the things that you need to actually keep in mind. Right? So we've covered all this stuff, and where can we get all this information? There's like so many things, right? Like, how can I do this? Like, where can I get all this information? So the places that you can do it's that the first one is on FSM1 website and other websites like ETF.com, ETFDB, the index website, right? For example, earlier, remember the Morningstar? So MO80, that particular ETF tracks the Morningstar index. So on MO80's website, I don't know what is the methodology. So then I need to go and find under Morningstar's website what actually the ETF does, because it's a rules-based index, or on the issuers themselves, like those who issue like JP Morgan, right? So you can actually, JP Morgan themselves actually tell that, hey, this is how we do it. Okay, so these are the places that you can actually go and find your information. So a brief overview of because I wouldn't be going too much into the other websites, but I'll just focus more on FSM1's website. So when you actually go into the website and find the ticker symbol, on the first page itself, you can actually find this information. What does that ETF do? Some other information that you have to know. Remember, here will be mainly the expense ratio. Do they like give dividends if this is something important for you? What is the frequency, every quarter, monthly, or regularly? Okay, like the past performance, we can actually toggle between ringgit and USD, but I'll just keep it on USD just to make it like a better comparison, because ringgit is more of the FX impact. What are the holdings? And like a quick look at it, you'll know whether they are equally weighted or market cap rated, right? And sectors. So that's just like a quick overview. So once you have gotten this information right, so you have all this information, at the end of the day, it's that what you might want to do, it's that this is just an example, right? To come up with a summary. So you can open up an Excel. You can follow these are the pointers that you might want to take. You can actually add in more than this if you want to like research deeper, but this is like good enough so that you can have an understanding of what the ETF does, right? So after a while, when you do this, you will quickly know like, okay, VOO, and in your mind, you will know that, okay, it's market cap weighted, it's S&P 500, this is the expense ratio. So like you will know that what you're actually doing. Okay, so there's actually a saying in Malay, right? It says like tak kenal maka tak cinta. So if you actually don't spend a little bit of time of getting to know that ETF that you are looking for, then you'll be just simply swayed by the market waves, right? So it's important that to just do a little bit of research, and it's not that hard to do that research. So after today's session, now you already know what are the things that to look for. So I've given you all the things, that important things that you need to look for. So then in a while, I'll show you, you can actually do this very fast. It's not that hard to get this information and to just compile this, right? So in your Excel, you might just, once you have that, you can just build and then do your comparison table. So you have like a side-by-side comparison between two different ETFs, and then that will help you to make a decision. All right. So now I'll just quickly go do a demo, but before that, just take a sip of my coffee. Okay, right. So this is the FSM1 website. So as you can see, the different products are here. You can just go to ETFs. And now the question is that it's like this. Okay, now you already told me about all the stuff. Okay, I understand this. Like, so where do I start? Like, what do I need to do? Like, how to get ideas right? Like, what to do, where to invest, and all that. So a good place to start is that by going through under research, the ETF ideas. Okay, so these are the articles that's written by our research team, and you can actually get some ideas of some market trends, some sector specific and industries of on what's happening. So based on this, you can actually get some insights. Okay, maybe I can consider electric vehicles. Okay, so then I click on that electric vehicle, and then then there will be a case for it, like the investment thesis here, like why electric vehicle, and then what are the instruments that you can actually use. So then they have these ETFs. So now when you actually read this article and see the weightation and all that, then the article actually makes more sense to you, because now you already know that, okay, how the ETFs are structured and all that, right? So then it is more clear for you, and the insights that you get from the article will be more clear. Okay, that's one way you can actually start with. Another way is that under thematic ideas, where it's already clustered for you, the categories that's over here, you can actually choose any categories that might interest you. So that's, let's say, aging population. So you can actually click on it, and then you wait. So this is both stocks and ETFs. So there are some stocks and also some ETFs. So you can actually quickly find whether any ETFs are available. Can't see. Yeah. So that's ETFs. That's ETF. Okay. So that's another way. Besides that, what you can do is that you can go to ETFs and use the ETF selector. Okay. So under the ETF selector, so there are a couple of selectors that you can actually play around with. Okay. Asset manager group, I wouldn't actually mind on this. Or underlying asset, it's something that you can consider. Asset class, it's the different type of asset classes. Remember, ETF, it's not only equities. Sectors, geographical sector. For example, let's say you're interested in India. Okay, because I believe that that's growth potential for India, and then you get a filter of like 22. So they are all these ETFs that's in India. But then let's say you don't have the time to actually just go and check one by one. So what you can do is that you toggle to on the ETF focus list. The ETF focus list, it's a list of ETFs that's like done research, where research is being done by a research team, and it is recommended by the research team. And so from the 21, then you get this one particular ETF. Okay, so and then you can actually click on that ETF. And get more understanding. So what does it do? It tracks the MSCI India index, and then you get the information. So all this you can actually take and put it up in your Excel. What's the expense ratio? Okay, dividends declared. You can have history. What's like the performance of it? What are the top holdings? Top 25 holdings. Okay, mostly finance sector. Okay, so you get an overview idea. Okay, besides that, what else you can do is that, let's say I turn off the geography sector. Okay, so let's say I'm not interested in country. I'm interested more of like particular sectors. Okay, so that's like climate change, cloud computing, consumer goods, right? Let's say technology, right? Let's say I'm interested in technology. So at the same time, so it's like 191. And let's say I'm actually only interested in the US market. But before I do that, I can actually just turn on the focus list. Then it comes just 5. So of these 5, then I could actually compare it. But maybe I'll say that, okay, this is internet, this is information tech, or this is internet, or this not just robotic, but it's internet. Okay, I can click on that, and I can actually compare the performance in a chart. Okay, so we're getting to like longer term for 10 years. So you can have a better view. Okay, and then you can also kind of see that, okay, this particular ETF, the global shares internet giant. Okay, that's a new one. Okay, I mean, this one started way longer. Okay, so that is one way that you can do. Another way is you can, so you now from what you have done, it's that from from a particular sector geography, you have drilled down to actually certain ETFs that you can use to compare. And then you have certain ideas that, okay, this is what I can do. And then you can actually bring this a little bit further and learn more about those ETFs, because here you can actually, you found the information, but another way I would also recommend is that by using ETF.com. Okay, so ETF.com, you can actually use the comparison tool. It's pretty cool. So earlier was those two, right? Okay, so I can. Okay, so let's compare. So this gives a side-by-side comparison. So just remember, okay, this is PNQI, OGSI. So it gives you a very quick side-by-side comparison, right? What's the expense ratio, the asset under management, and daily volume that's traded, okay, number of holdings that they have. So pretty similar. What are the historical returns, okay, and the spread, and the holdings that they have. Okay, so to give you an overview and on an idea, right? The sectors that you can see here that the PNQI, can actually toggle that, they actually, and the OG, the sectors most similar. Countries, they are mostly US, spread across. And okay, so you have the percentage over here. If this, you can't see clearly over here. Even the sectors, you can actually see that percentage over here. Okay, so once you have done this, and another thing that you might want to also say is that, let's say you can actually go in detail, okay, of both to get a summary of it. Okay, PNKI. Okay, so you can just read what do they actually do. So this is like, it's more of the software companies. And then this is the index that's tracked. So you can actually go and read in detail, like what are the methodology that's used to track, to design this index. Okay, what else? What about this? So focus. Okay, so see the focus is different. The way they do things is different. So they actually define quality by the cash burn rate. So cash burn rate is like startup companies, right? In the earlier days, like they spend a lot of cash to actually build up their product, to get market, to get customers, consumers. So they have cash burn rate. So that's what, like using investors' money. So they are, and also the universe that they invest, it's 1,000 largest US listed companies. So they have a mixed bags of it. Okay, so get an idea. They are not actually like apple to apple comparison, but they kind of have similar holdings, right? So once you've done that, then it have like tabulated all this information. So other things that you can do here is that this is called the universal search over here. You see this magnifying glass, and just quickly search the ticker symbol, and then go to articles, right? So there's an article. So whether there are any articles that's related to that ETF that you're researching, that's already on FSM website. Okay, so this will actually make your research easier, because that's already like information that's done. So you can actually quickly read the comparison, what's the difference, okay, how it's being done, and talk about the holdings, the different exposures. Like for example here, like number of profitable companies in PNQI, it's more than OGIG, because remember earlier, because of the methodology that they use in OGIG, right? Startups. Okay, the exposures of big tech. So this by doing this, prior to that, it's that you have an understanding of this. They are actually in internet companies. You have done a comparison, and then the way that they are structured, then you have a general understanding. So with a good general understanding, when you actually go and get more information and you read up more, then you have a better grasp of the information that the further research that you're doing. And all this could help you to shape your investment decision, which to choose, right? So you can just go through that. Okay, so we'll stop share over here. And then what I'll do is that I'll just quickly see if there are some questions. Recording, yes, that's recording. My drop questions for trading US for the tax charges. Yes, I'll cover the tax. How will the dividend banked in? The dividend will be credited in your FSM1 cash account. Yes, listen, so it pass away then. Correct. Actually, correct. You're right. 45%. I understand that you stated check my tax lawyers holdings. Correct. This means to get out of US, but I purposely transfer out of my US brokerage account to FSM since getting old and high chance coupled lower. Okay, cool. Moon Kyung, right? Moon Kyung, maybe what you can do, sir, is that you can actually drop us an email on this so that we can actually get a call and have a better discussion on this. Yeah, I understand your concern, and what I'll suggest that for you to drop an email so we can actually have a direct discussion on this particular matter that you raised. Okay. Is there any delisting risk of ETF? Yes, there is, because of if the ETF is too small, there is a risk of that. Based on research, what is typically the difference in return between passively and actively active managed ETF long term? Right. It actually depends. Okay. I mean, okay, you say like based on research of past performance, right? Just go and you can actually do this. Go and compare the returns for QQQ and ARK investment. Correct. So what I want you guys to take away today is that to learn the thought process, and so that you will be able to do the research yourself. That's my main objective today. It's that you learn how to do it. Like I'm teaching you how to fish. You understand the thought process so that you are more informed to do how your research. So I'll throw back the question to you, Marcus. So do the research and maybe you can tell me. If I do not want to be bothered about tax, just focus on equity tax. Yes, if I do not want to be bothered about tax on the dividend withholding tax, yes, you can actually don't have to bother about the dividend yields. Yep. So because almost all US-based ETFs are distributing, they are not accumulating. It means that the dividends are distributed for tax purposes. Is there a certain minimum amount gain before we should consult tax advice in terms of dividends? No. Okay, for the dividend, right? Again, it's not that you are taxed on that after you get the dividend. It's the dividend is actually taxed, and the dividend that you get, it's already taxed, and you get it in your FSM1 cash account. So that's one question. Whether to declare this as an income, that's another question. And how do you want to do this? Then I'm no expert. I can't advise on this because I wouldn't know also. So that's why I say that it's better to consult with a tax advisor. Right? Okay. Good stuff. Yeah. I will, Mr. Moon Kyung, I will actually drop you a text after this on the email. Then we can chat on that. Okay, so let's take a short break. Around 5. Is 5 minutes okay? Is 5 minutes okay? Or 10 minutes? I think 5 minutes should be fine, right? Just quickly go for a toilet break and refill your coffee. We will come back and then we will go through the second part of it where we actually learn how we can actually use all this knowledge and construct a portfolio. All right, let's go. Right. All right. Hope everyone's back. I'll just give like a few seconds for me to set up the slides and wait for the rest to come back if you're not ready. Okay. Sorry, wrong slide. Okay, Joe, let's get started. Sound check, cool, right. So I'll go back here, right? Just a short recap. The first part of the session is that we learned about ETFs, how ETFs are structured, what are the different types of ETFs, how they actually track an index, actively manage, passively manage, smart betas, inverse leverage, right? And then we actually saw that after understanding all this, what are the costs that's involved and how actually expense ratio matters if everything's equal. You're comparing two ETFs and that could be actually a deciding factor. But one thing that I need to actually caution here is that not to actually overanalyze. If we just take, for example, the S&P 500, right? That's the VOO, the SPY, SPLG, IBB. Except for SPY, which is 0.09, the rest of them are actually totally, they do the same thing. So don't, I've seen, actually I'm equally guilty of that, is that to go to the detail of analyzing the performance difference until to that extent. What happens is that one thing is that you'll use up too much of unnecessary brain power for something that is minute. Second thing is that most important is that just to get started, right? So that is something that you might actually encounter once you get into the idea of researching and comparing. Okay, just to pre-warn. So don't get too caught up in that. Have the basic, the general understanding, the detailed understanding that makes it different. For example, that you saw in the article between the PNQI and the giant share ETF. So that is a very clear-cut difference. And then based on that, you can actually make your decision. Done. So with that said, let's go to the next section. So now we know about this tool. We already learned about this tool. How then do we use this tool to actually construct a portfolio, right? So this is a step that you can actually, a guide actually you can adopt to do this. The most important number one is that to start with an investment thesis. It's like you have this tool, you're going to use this tool, but before you actually use the tool, you must know like what is the project that you're going to do, right? I mean, am I going to build, I'm going to like construct a desk. Am I going to carve? I have this piece of wood. Am I going to like construct a desk? Am I going to carve it in a, I don't know, wood Michelangelo? So it depends on your goal. Then you need to use different tools for it, right? So you need to have in your mind that what is your goal. So with that goal, that is the why. So that's the first investment thesis. Second is that circle of competence. This is very important in the sense that, okay, you say that you want to actually go and invest in AI, right? Then you have done this research. If you don't have any experience or understanding of that industry itself, then it'll be more harder for you. I wouldn't say that totally no, but you need to actually do more research to understand that industry. So what I would say is that if you want to go like specific industries, start with your immediate circle of competence. Let's say, for example, that you're actually working in a bank, in the financial industry. So you're kind of familiar how banks works, how banks makes money. So then you can actually go and explore in financials, just to get it started. Or maybe you're working in semicon, you're based in Penang, you're working in one of the semicon companies. So you're very familiar with how the ecosystem works. So you can actually start with that particular sector. Okay. So next is that we're always investing not based on past results. So it's not always a good idea to just look at past performance and assume that that's what's going to happen next. And that's what actually a lot of people did the past 2 years, including myself, and that didn't turn out so well. So what's more important is that we are investing based on what's going to happen next, the future outlook, right? So what are the factors that can actually spur, what are the catalysts that can contribute to this future outlook? And of course, geography. Geography, like earlier we have seen, right? Japan, India, and then could be China, Malaysia, and why this particular geography, okay? Once you have done your investment thesis, this needs to be like, you need to take some time to actually form this investment thesis. It's very important. The next is that actually to know your strategy. What are the strategies that you're going to use it? So that strategy actually depends whether it's for a long term, for a short term, medium term, and then what are the asset class that you're going to use it, and the style. And finally, then only you actually go into your ETFs, then picking the ETFs, this or that ETFs, right? So the topic that we did earlier, right, on how to look at ETFs, that should be actually the last step. Like, even though we covered that first, but that should be actually the final step. Before you actually go into that, you need to actually have thesis and the strategy, because that is the tool that you're going to use. All right. Okay. Sorry. Okay, next. And something that I'm passionate about is always to tell that everyone actually, before starting to invest, to actually form an investment thesis. This is very important. Okay, so in this example, I will actually give of an example of investment thesis. So I've already explained earlier on this, like why you need to have an investment thesis, because you need to have a goal. It's like, I also always tell this analogy, right? Like if you're actually flying from KL to Penang, sorry, if you want to go from KL to Penang, there are many ways that you can do that. You can take a flight, you can take a train, you can drive, take a bus, right? So, but then what actually decides which mode of transport that you're going to use? So time factor, urgency, cost, okay, all these factors will actually will help you to decide. So once you have actually identified, okay, this is the particular way that you want to travel. For example, I want to take a flight, and then I decide like which airlines I want to take, right? Whether Firefly, AirAsia, Mars, My Airline, or more ready. So yeah, these options. So that is where it comes on selecting the ETFs in this sense. Okay. So in this example, it's that my investment thesis is that I'm actually investing in the US market, and I'm using ETFs to actually invest in the US market. So my why, and this is my thesis, why US ETFs. Okay. So again here, this is not to actually influence you to follow my thesis. This is just my thesis. My aim here is to actually look at the methodology. Like if you want to, you can actually replicate this methodology in any industry, sectors, countries that you want to do. And what's important is that to have this strong why of why you're doing this. Okay. So for me, it's that simple. If I look at the most valuable companies in the world in any sectors, in most of the sectors, what I can see that they are all mostly US listed companies, whether in the IT sector, definitely not oil, financials, consumer discretionary staples, healthcare. They are mostly companies that's listed in the US market. Okay. And another thing is that these are actually global brands. They are not just tied, their revenue is not tied to just US consumers, right? Like we ourselves are actually consumers of almost any one of these products. Definitely all of us here, right, would have in one part of your life will definitely have used one of these products. So their consumer base is global and not just tied to a local consumer. Okay, that's another reason. Okay, next is that the way that the S&P 500 is structured. It has gone through many ups and downs and many recessions, but it has always been on the uptrend. That's also due to the way that the companies that's being listed there, right? And also due to inflations and also the growing number of people that's using it. For example, okay, like this, right? Can do like there's this argument like, can Apple grow somehow? Like, isn't like everybody knows, like everybody's using Apple phones and all that. How else can it grow? So what about, okay, so my understanding is like this, right? When a society becomes more affluent, so when the emerging market economy becomes more affluent, for example, let's say Indonesia and Vietnam, so the product they tend to use so also will be more expensive. right? Like we saw that actually happening with China, right? And that's why a lot of US companies for the past decade were actually rushing to actually go to China to get the China domestic market. So the room for growth for these companies are still there. When the emerging market grows, this companies also has a room to grow indirectly. So it's just the way that my understanding of that, right? So, and my most important thought process of doing this is this natural selection, right? So the survival of a fittest, this is actually a biology concept. Okay, if you see here, in 2001, these are the stocks that's listed on the S&P 500, the top 20. I think there are 20 here, right? And in 2021, after 20 years, these are the top 20. That you can see that the one that's highlighted in gray are repeating, but a majority of them are not. Okay, so it's like totally an entire new players here. Like we don't see Nvidia here. Do we see Apple? No, that's not even Apple here, right? But that's Apple here. Okay, there's no Google here. So what happens is that if I'm actually individually picking stocks, selecting stocks, let's say like this is 2001 and I'm holding GE, I need to monitor the performance of the company, the future outlook of the company, how the quarterly earnings of the company to access my holdings for that particular stock. That means I need to be actively involved in managing my portfolio. But just by holding S&P 500 ETF, it automatically does that for me. It doesn't matter that today G is the biggest, largest, and tomorrow it's Apple, and maybe in the future it's like some new company that we don't know yet that exists, right? It doesn't matter. Like at any time, any point of time, I'm holding the top 500 largest stocks listed in the US stock market. So that's nothing on me to actually actively look at it. So remember the earlier point that I said that ETF, it's automated. This is what I meant by automation in one sense, where I know that at any point of time, I'm holding the top 500. Okay, right? And the selection pools happens naturally, like let them fight and let them come out. Anyhow, whoever wins, I win. Okay, right. And at the end of the day, it's that the time frame. Remember the time frame that I said? This is not for speculation. This is for actually investing for a long term. So these are the companies that I'm actually happy to actually hold for a very long period of time to grow the wealth, to compound it over years. Okay, so the mindset of that. Okay, so now once we have established that investment thesis for why investing in the US market, now how can we do this? What are the strategies? So the strategy, there are actually many strategies that you can actually use. So you can actually trade the market. You can actually use leverage. You can use inverse ETFs to short the market, so-called, right? So, but I prefer a more hands-off approach of the core satellite strategy, whereby I have my core broad market ETF and a few satellite ETFs to support the core. So I have kind of the best of both worlds, right? Where I have the broad market to get market returns and also some smart beta ETFs to actually help to propel the returns of my portfolio. Okay. Okay. So how do I then structure this based on this understanding, right? So the way I do it's that, remember earlier, not to have too many, one, two, three ETFs. We can go up to 5, right? And this is a way I actually structure it, whereby I spread it equally between the core ETF, quality ETF, and growth ETF, right? So for core, I'm using the VOO, which tracks the S&P 500 index. For growth is the FTEC, which tracks the broad US information technology. So this is not just the the software companies, but it's across all IT tech sectors, right? And then for quality, it's the JQEA because of where the companies are actually kind of, you can say, blue chip companies, like they have included the quality factors of profitability, earnings, and solvency. Means that they are stable. So they are not like, you wouldn't say too much of growth, but not too much of drawdown. So it's like slow and steady. So my core and my satellite together, I form a portfolio. Okay, so this is just an example that you can actually follow. But what's more important, again, I said, is the thought process behind of doing this. So you can actually come up with your own example with this thought process, right? So that's done. So this is just a simulation of really visualizing how the portfolio actually performed from for the past 5 years. So you could actually just hold the S&P 500 index. That is the compound annual return of 10%, or the famous QQQ 14, or the portfolio that I'm using, 13.56. Okay, then people can say that, okay, can argue, hey, actually, why don't you just put it VO and QQQ and you get like 14%? That's pretty cool, right? Just put in one sector. Yes, in hindsight, it looks cool. It has higher returns, correct? I mean, we can all do our simulations and find the best performing in hindsight. But when you're actually doing it, that's when the psychology comes in, because investment, as we all should know, it's very much human driven, human behavior. What I mean by that is that during the best years, everybody's happy. During the worst years, right, that's when he messes up with your psychology. So when you see a portfolio that it's down by negative 25%, so like in your mind, like usually there will be a barrier. Okay, how much low I can go. So then if it's going lower and lower, then do you have the conviction to actually stay invested and build on that portfolio more, right? So just looking at numbers on charts, on papers, it's okay. There's no emotion attached. But when real money is at stake and when your account is at stake, real money, then you would definitely would have experienced this of that emotion. So to have a peace of mind, I don't mind actually sacrificing a little bit of return for that peace of mind and just keeping on track of consistently investing over time. Okay, and even the risk-adjusted return, the Sharpe ratio, the higher the Sharpe ratio, the better. Means that if I'm taking this much of risk, what is the return that I can get? So naturally, if I'm taking more risks, then I expect more returns. So the risk-adjusted return is also higher compared to this portfolio. But don't take my word for it. I'll always say that go and do your own research, validate this. Again, it goes back to your own investment thesis. Like if you say that for you, I don't mind, but it goes to like 30%, I'm cool, I'm chill about it, then by all means do it, right? So it's very different from different individuals. But what's important is that for you to able to articulate this, you have to be able to articulate your investment decisions of why you're doing it, right? So done. So now we have done the portfolio. We have seen how to construct, what is the type of portfolio. We have seen the allocation of it. And now how do I actually invest it, right? So the style that I'm using, it's the regular savings plan, or in other words, the more common word is DCA, dollar cost averaging, whereby I'm going to contribute a certain amount monthly to that portfolio, right? So why use this method? Okay, you could actually just do a lump sum and then wait for it, or you could actually use this method. But why I choose this method is that because I don't have to actually try to time the market. And most importantly, it's that I could actually automate this entire process, right? So when this entire process is automated, I've done all my research, I've done my homework, I've selected my ETFs, and I've constructed my portfolio. Now, I just want to consistently build that portfolio over time and let it grow over time, okay? So in order for me to do that, the less work is there to be done, the better. Why? Because what gets automated gets done. Okay. So actually, you can actually see this playing out real life with our EPF account. Like our EPF, month by month, it grows, right? And we don't actually see it, but at one point of time, you just do nothing, and hopefully by your retirement age, you have this sizable portion in it. But you don't actually feel it, right? Because it's the entire thing is automated. Okay. So, and number one, it's to remove that emotion to do it every single month. Okay. And it also puts in the discipline. So that's why RSP helps to achieve that. Next is that, what if like I'm actually quite good in chartings and I can actually use these indicators and I know when is the market bottom, I'll buy during the time, no problem. But based historically, right, this is just on historical data. If you actually invested in the stock market between the past, this 20 years, 1929 to 1979, two scenarios. You can do this. Either use the RSP method, which is the DCA method. You invest diligently $100 or ringgit every month for 40 years. Or you do the same thing. You also invest 100 ringgit every month, $100 every month, but you actually buy during the dip. So the dip means is that the very bottom of the market. Okay, and let's say that you are very savvy enough to use technical indicators to actually know when is the best possible way, best possible time to actually go in the market. Historically, it shows that buying the dip actually underperforms 70% over time, right? So there are times that it doesn't mean that you don't actually do well. I mean, there are times that you actually do well, where you outperform, but most of the time you actually underperform. And then when we actually compare side by side, so the DCA, which is the RSP method, regular saving is the black line, and buying the dip, it's the blue line. So all the dots are when you actually buy during the dip of it. And this is just buying and accumulating, not buying and selling and buying and selling. Okay. So also it goes back to going back to your strategy earlier. Remember, we always start with strategy. So then you know, if you're savvy enough that you know that you can actually use indicators to do it. But what's important here is that to have an automation, not to worry too much, get it done, set it up, and get along with other parts of life. Okay, so we are almost at the end of the session. This is the very last part. It's that how can I do this by actually building a portfolio starting from 100 ringgit a month in ETF, right? So how you can use the tools in FSM1 to actually do this, okay? So the plan that we have, it's called the FSM1 regular savings plan, whereby you can actually invest in fractional shares. So when we say that from 100 ringgit, it means is that you're actually getting fractional shares. So the reason being is that you don't want to be set it back because you don't have enough capital. What's more important is that to get started and slowly build up. So once you have that capital, and of course there are some restrictions in using this system, but once you have built up that, then you can actually change to other method altogether. It has a low processing fees compared to outright buying the ETF itself. Okay, the flexibility, you can actually choose 4 different dates when you want to actually do your ETF, either on the 1st, the 8th, 15th, or 22nd of every month. So tomorrow will be the date, so the next immediate date. And then there are actually a wide range of ETFs. I think the numbers have increased a bit now. It's more than 103 ETF that's listed in the US and Hong Kong markets. Okay, and then there's no lock-in period. Anytime that you think that this doesn't work for you, and you can actually terminate it and stop the ETF RSP contract. Okay, one example it's here. So this is actually on 3rd of August. So if you are just buying that one single share of VOO, that will cost you $413 USD, right? So by using the ETF RSP, you can actually start from 100 ringgit, which means that you're buying fractional shares of 0.053 units. So this is the advantage of using the RSP method. Okay, and this is also based on past data. Investing 100 ringgit every month in the S&P 500 ETF, which is VOO. So after 10 years, this is the amount that you'll get, 22,000. That's around 11% annualized. Okay, so, and the reason that also we are doing this webinar now, it's that because until end of 31st of October, we are, FSM1 is actually giving a promotion of 0% processing fee when you create any ETF RSP contracts by end of this month. And you can actually enjoy this 0% processing fees until December 2024. Okay, that's two parts to it, right? One is if you create the contract by 31st October, that particular contract, you enjoy that 0% until until December 2024. Right? So to get started, it's that what I will actually suggest more is that to actually set up this entire thing into an automation. First, I'll just quickly explain here, and later I'll show you on the website how you can actually do this. Okay, the idea is that, remember, automation. Automation, once you have things automated, it takes away the emotions, and it happens in the background, and it's more disciplined way of actually saving, right? So every month when we get our salary or you have our savings account, what you can do is that actually create an RSP contract to the FSM1 cash account. And this happens only on a monthly basis. It's the 15th of every month. So once you have already funded the cash account, for example, let's say the portfolio I showed earlier, right? So 100 ringgit each, so that's 300. So every month on the 15th, I do an auto debit from my bank account into the FSM1 cash account on the 15th. Okay, and then automatically, maybe if now it's 15 is done, on the 15th or on the 22nd, then I do another RSP automation from my cash account to fund my ETF portfolio. So I just need to set up this entire flow once, and then every month this actually happens in the background like a machine. It just runs. Okay, so so instead of like manually funding, maybe for the first time you need to manually fund your cash account because this only happens on the 15th, right? So you have to look at the timing. So maybe on the first time that you're doing this, you need to fund your cash account. But all the subsequent months, once this process is set it up, then it runs by itself already. Okay, so let me quickly show you how it actually works on the website itself. Okay, so let's go back. So for this, you need to actually log into your website. You need to have a CDS account. Okay, so here you go to ETFs, and you can look at regular savings plan over here. Then you can actually scroll down to the RSP list. That's the list, and that's ETF. And these are the ETFs that you can actually look at it. Okay. Remember earlier we did the ETF selector, right? So what we did was that looking at the focus list. But if you're interested in the focus list and also the RSP list, you can actually also filter from here. Toggle the RSP list, filter list, and then based on the criteria that you're searching, right? You can actually, like just earlier we were doing technology, right? So let's do technology. And then, yeah, so this ETFs are actually both in the focus list and RSP list, because sometimes they could be on the focus list, but not in the RSP list. Okay. Okay. We'll go there. Okay. Another way for you to look at it is that you can just filter here, and you can see that the one with the tick, that is the one on the focus list. Okay, or you can just search for it. Let's say I'm interested in this particular ETF mode, and then I click on buy. Okay, so automatically then the order pad pops up. Then you can actually put in the amount that you want. Let's say I start with 100 ringgit. So now since it's until 30th or 31st October, right? So that's 0% processing fee, but that's actually one more charge, which is the stamp duty. So for every 1,000 ringgit, there is a 1 ringgit stamp duty. So yeah, there's a stamp duty here. Okay, so to understand more, you can click and look at how that works. Okay, and then what happens is that, for example, let's say now I'm putting 100 ringgit, and maybe along the way down the road, I can actually edit and increase this amount. So it doesn't matter, it doesn't affect the contract. in the sense that the processing fee. So this is actually, once you put the contract now, then you get to enjoy this. And then I'll just pick the date. Maybe I'll just put it on the 1st of November. Okay, then add to cart and proceed to checkout. So it is on the 1st, that's one time. And then I submit the transaction. Then just wait for the scheme, the tag 12205. Done. And okay, orders placed. So I can go to my view RSP and I can actually check. Okay, the orders placed. It's on the 15th. Oh no, where was that? Okay, mode on the 1st. It's active. Done. So anytime I'm actually let's say I change my mind. I want to change the date. I can go and edit RSP, and I can change the date. I can change the amount. I just click on update. Okay, that's done. And then for selling, sell, it's that for scheduled sell, since these are fractional units, the scheduled selling only happens once per month, which is on the 15th of every month. But let's say you have accumulated over time, right? You have accumulated like more than one unit. Let's say you have like 2.5 units. So that 2 units you can actually sell on the open market, like anytime the market is open. Okay, but the 0.5 units, since it's fractional, it could be only sold on the 15th. That's one. And at the same time, also to note is that on the fees is here. So if you're actually buying an ETF outright, this is the fees, minimum of USD 380. If you're using the RSP, I've shown it's a minimum of USD 1, but now we are having the 0% promotion. So what happens after the promotion? Then it goes back to the minimum. And also there's a stamp duty. But so these are the fees that you have to take note. Right. So yeah, pretty cool. We are right on time, 11:50, and that will be the end of my presentation. I'll just quickly take some questions. We can invest in FSM ARC ETF. Oh, actually, it's not FSM ARC ETF. FSM, it's the platform. The ETF is the ARC ETF. And All-in-One Disruptive Innovation Fund. It's no brainer to invest in ARC ETF. Fees are lower. I'll say, but what I'll invite you is that to actually compare it, to see whether both actually track the same index. No. I mean, there's no index for them to track. But if it's the same thing, then looking at the cost of the unit trust and the cost of here, these are the costs that I've shown you, then you can make an informed decision based on that. Would I be able to get this type of simulation FS1 platform? Oh, the simulation, no. The comparison of the chart gives you the return simulation, but the detailed one, you can actually use a website called Portfolio Visualizer. When is the best time to sell since RSP has automated monthly pitches? When is the best time to sell? Yeah, sell is actually on the 15th, that's scheduled sell. The automated purchase are the four options. I think your question will be, when is the best time to buy? I'll say that either on the 1st or on the 22nd, but again, it's up to you. You can actually look at the past returns and kind of compare. Let me show you what I mean. You can actually use the calculator to actually play around the returns, right? But then again, that past returns doesn't actually equal to future returns also. So it's not a straightforward thing like that. What is the difference between focus list and RSP list? Okay, right. So focus lists are actually the ETF that is I wouldn't say recommended. Our research team has done research on this particular ETFs, and compared to other ETFs in that similar category, this is preferred. So that's focus list, right? So in the I can also show you what it means. So if you go to the ETF selector, So that's so in focus list, there are actually 63 ETFs, right? But under the RSP list, they are 112. Okay. So under the focus list and RSP, that's 53. So the RSP list, those ETFs on the RSP list are the ETFs that you can actually purchase with the RSP method. Means that the one I showed you earlier, right? Of a minimum of 100 ringgit. So if the ETF is not under the RSP list, then you need to actually buy that ETF outright on the stock that is listed. So more or less like focus list, it's more of like our research team have done some research and on this particular ETF, and most likely that if it's on the focus list, there will be also some articles on that particular ETF. So it helps you to helps you to scan through and focus on this particular ETFs in the universe of ETFs. Is ChatGPT good advice on ETF? Okay, remember okay. ChatGPT, how good is ChatGPT is how good the question that you ask ChatGPT. So the quality of your answers depends on the quality of your questions that you ask. So if you give it good prompts, then it will give you a good advice. If I invest less than 100K per time, IG per time, what is the stamp duty? Yes, the stamp duty is that every 1,000 ringgit, it's 1 ringgit. So if it's 500, that is less than 1,000, so it's 1 ringgit. If it's 1,001, that's 2 ringgit. Does FSM provide bond ETF to buy? Okay, it's like this. Again, ETFs are instruments that's listed on a stock exchange. Okay, on FSM, we have access to the stock exchanges in the US, Malaysia, Singapore, Hong Kong, China. So if the ETF is listed on Hong Kong Exchange or NASDAQ or New York Exchange, then it will be available on the platform, right? And bond ETF, yes, if you can actually find, like for example, that's the BND. So short-term bond. I'll be using this. Okay. Then go to ETFs. Then you can see when got total bond market. Okay. So it's available. But okay, once you have done this, right, important is that you need to go and research, right? Again, go through all the criteria that we have been through and understand why you want to do this. Okay. And also remember how you need to also understand how bond works. So the price that you're seeing here, it's actually different from investing in bonds itself. When you invest a bond, you're holding the bond until maturity and you're getting the coupon payment. The price is the price of the bond. So when the bond prices actually fluctuates, actually this movement in price, it doesn't matter if you're holding a bond until maturity. So it's a bit different strategy, buying a bond ETF or a bond fund compared to buying a bond itself. What's the expected return compared to unit trust? EG is 10% a good return. Okay, so what is an expected return, right? So when you talk about that, what is an expected return is that in our mind is that we need to have a benchmark on returns. So we can see that for FD, right, that's 4% return. So that's risk-free, right? I mean, your capital is guaranteed up to 250K and all that. So if I don't take a risk, I'm getting this currently 4%. Some banks with their structured product, they have this 5% and above. So then if I'm taking a risk on the market, then it needs to be more than the return that's given on a risk-free rate. Okay, that's one. Second is that go and look at the broad market. Okay, the broad market in S&P 500 and that ETF is VOO, right? So you take a 10-year and you can actually use, there's only 10 years data here, but you can actually Google for a longer term period, 30 years, 40 years market return. So you can see that annualized is around 10 to 11% based on history. So this is actually in your mind that you can use as a guide, the expected return. right? Then you can actually compare. So even when you compare, right? I mean, you cannot take like the US market and then compare it with a different market. You compare in similar market, right? So it wouldn't be fair to do that. You have to have almost apple to apple. I mean, if you can't compare like apple to apple, but almost apple to apple will be also a better way. Sure. In venture bonds versus CPF. Yes, correct. Bonds versus CPF, actually, yeah. Because in the sense that the CPF or in our EPF, it's similar to bond because it's government actually guarantees for EPF, right? It guarantees 2.5, and but on average we have around 5 to 6%. It's pretty good. Touch wood, that continues, and that's no risk on our side. Too much money in the fixed income via EPF, CPF does and focus on equities, great for my family investments to have a good. Oh yes, correct. Actually, yeah. That is a good way because in my earlier session before this, I showed a chart whereby most of people actually their investment, their net worth is tied to either their retirement fund, which is EPF, or their properties, majority, right? So besides that, you need to actually, and these are actually like stable, slow and steady. But for growth, you need to actually have another instrument. And this is where like ETF comes in. Okay. So it's like this. For investments, right, you can actually spend time and do research on companies and like look at their financials. I'm talking about investments, not speculating or trading. And if you have the time for that and you have the interest for that, you can do it. But that's also another way, which is ETF, because it gives you that access to the market. And I've shown you that once you understand the step process, the logic behind of how to look at an ETF, it's very fast that you can actually analyze an ETF and come to a conclusion. You know, you can just spend an afternoon on a weekend and you can actually do this. So it doesn't take a lot of time compared to actually sitting down and analyzing a company by itself. So to get started on equities, this is a good way. Okay, so yeah, we are right on time on dot at 12 o'clock. If there are no more questions, thank you so much for attending today's session. I'll just reshare my slides. I hope that's right. Yep. So again, to recap, it's that, yep, this is what I wanted to show by Q&A. It's that far more time, actually money has been lost by doing nothing, like waiting for correction, like is a recession coming, the war is happening, what's going to happen to the market, and then actually being in the market, right? I mean, there's a saying that time the market is better than timing the market, right? So by using this ETF RSP method, it actually gives you that access to be consistent in the market and not to like worry too much, okay? And also it helps you to kickstart and get yourself started, right? And also, I hope that this can actually help you to understand about ETFs better. And I hope that the information that I delivered today could actually help you to make a better understanding of ETFs. And if you have any more questions, I might not have covered, and you have further questions, feel free to actually drop in an email to us, either at Client Help or Invest Help. So we are from the Client Investment Specialist team. So you can, if you would like to reach to us on investment related, you can actually drop us an email here at Invest Help, or you can actually call in any of the branches across Malaysia. All right. So with that, thank you everyone and have a good weekend. Thanks for your time and ciao. Bye-bye.